Lion-OCBC APAC Financials Dividend Plus ETF. Meanwhile, if you are keen to know how to subscribe for this ETF from now till 2nd May 2024, you can refer to our Podium's landing page that has all the details. I will share the link in the chat shortly. And we will also go through the steps on the subscription process towards the end of the webinar. A very good afternoon, ladies and gentlemen. Once again, I am Jason Fu from Securities ETF Desk. Thank you for taking your time off to attend today's webinar. It is my pleasure to welcome today's speaker, Mr. Ong Xun Xiang, who will be sharing with us on the world's first APAC Financials ETF, the Lion-OCBC Securities APAC Financials Dividend Plus ETF, where this ETF will be listed on Singapore Exchange soon. He will provide insights about how APAC Financials are deepening their strong fundamentals to bolster growth opportunities, and will also share how the ETF can be the building block for investors like you to gain APAC financial sector exposure and position your portfolio towards steady income and growth. Xun Xiang is the ETF Business Lead at Lion Global Investors, and he has built a wealth of experience in various roles across asset management, private banking, and fintech. He holds a Bachelor of Accountancy from NTU and is a Chartered Financial Analyst, Chartered Alternative Investment Analyst, Chartered Accountant Singapore, and ASEAN CPA Chartered Holder. Without further ado, let's welcome Xun Xiang to share with us on today's presentation. Xun Xiang, please.
Thank you, Jason, for the introduction. And good afternoon, everyone. Thank you for joining us during your precious lunchtime on a Tuesday afternoon. Okay, so right now, let me share my slides before I begin. Okay, so good afternoon, everyone. I'm Xun Xiang from Lion Global Investors, and can call me LGI's ETF guy. So basically today I'm here to share about how you and I can earn stable dividends while at the same time invest in APAC's financial strengths through this very special ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. So if there are two things I want you to take away today, it will be the fact about these two key features, which I will mention. The first one is about minimum 5% per annum quarterly distribution for this ETF, because this is what the ETF will be paying in the first 2 years. The second will be about it being the world's first APAC financials sector ETF. So this is an interesting ETF which I'll discuss much deeper into all these. And before I talk specifically about this ETF, perhaps let me give everyone also a brief introduction about LGI here. So LGI, we are one of Southeast Asia's leading asset managers, and we are part of the OCBC group. So today we manage around 71 billion Sing dollars of assets for our clients. And we started our ETF journey back in 2017 when we launched our first ETF, which was with Philip here on 2017 October. So this was our first ETF, the ETF that propelled and started our journey within the ETF business. And since then, between 2020 to 2022, we launched 3 ETFs within 18 months. So this translates to around 1 ETF every 6 months. And this helped to propel our business forward to around 860 million today, and propel us also forward to become one of SGX's top 5 ETF issuers. And earlier, around 2 months ago, we also launched Singapore's first active ETF and also Singapore's first AI-powered ETF during during the journey. And among our ETFs, what you can see here is that we have among these different ETFs, 3 of our ETFs out of these 5 will actually achieve top returns among their respective segments. So in 2023, we actually only had these 4 ETFs, and with these 4 ETFs, we actually achieved top returns among our REIT ETFs, which was for our Lion-Philipp S-REIT ETF. For Ong Xun Xiang ETF, we also achieved top returns among the SGX-listed China Equities ETF. And for our Singapore Low Carbon ETF, it similarly achieved top returns among our Singapore-listed Singapore Equities ETF in 2023. And based on further SGX data, we also achieved the top 10 ETFs. We are also among the top 10 ETFs held by retail investors during this period, where you can see our Lion-Philipp S-REIT ETF and also the Hang Seng Tech ETF among the top 2 and 3. And if we zoom in even further into the SRS investor segment, our ETFs also rank within the top 10 held by SRS investors. And in terms of trading turnover in the whole year of 2023, our ETFs also rank among the top 10 ETFs. And special mention for our Hang Seng Tech ETF was the top traded ETF for 2 consecutive years in 2022 to 2023. So all these are key highlights of our ETF journey. And because Lion Global Investors, we are headquartered within Singapore. So our mission is to deliver quality ETF products for the Singapore ETF ecosystem. And that is why we decided to build another new ETF focused on income, but also at the same time focusing on growth for investors. And we decided to zoom into the financial sector. And it is because the financial sector is a traditional and also old sector that has prospered throughout the centuries, being an essential capital provider for a lot of economies worldwide. It primarily includes companies that provide services and products that focus on the growth, storage, and transaction of money and assets. So all these help it to become an essential capital provider and has evolved throughout the centuries. So as you see, right, or when we started in ancient times, we actually used seashell money to be able to do barter trading. Then after that, it evolved into physical commodities like gold. And to what we see now today in terms of fiat currency, paper currency, and also evolving into credit lines and credit cards like what we see here. And today, in terms of the evolution of payments, we have also seen mobile payments where we can now pay through QR codes. And in the future, also about central bank digital currencies. So all these evolutions within finance have been important because of this primary factor that it is an essential capital provider for economies worldwide. So this is the linchpin in terms of why the financial sector is an important sector. And when we talk about the financial sector, it actually does not just consist of banks. Because other than banking, there's also the other areas because it's an entire ecosystem. So for example, it consists of investment management, like LGI here. So consists of insurance, brokerages like Securities here, and also exchanges where is the venue we are listing our ETF on, for example, like SGX. And precisely because the financial sector provides an ecosystem that helps to smoothen the flow of capital and enable economies to trade globally. So 2 key things to remember for the financial sector. The first one is that it is an essential capital provider. And the second one is that it is an ecosystem. So these are these two are key points to remember, because they set the foundation on why the financial sector is an investable sector and why it's important. So next up, I'll now cover about why financials within APAC. So in terms of the financial sector, it is one of the world's most profitable sectors, generating more than 12 trillion revenue globally in 2022. And within APAC as a region, more than half of adults within APAC are actually underbanked. If we compare to the world average or even compared to Europe. So because of this, it actually represents the largest opportunity set for a lot of APAC banks and also APAC financial institutions, where they can help to grow even further by serving the underbanked within these developing Asian countries. So because of this, there's much more room for the financial sector to grow within APAC. And when we talk about APAC financials, in terms of savings rate, the APAC savings rate is also much higher than the world's average savings rate, as you see here. And within APAC, the two key drivers are actually ASEAN and Singapore behind the high savings rate. So this is important in helping keep deepening the foundation for growth, and because a deep deposit base will be important to help provide further capital and further loans to help be able to finance the economy and provide capital to the economy. So much so that out of the world's top 30 banks by market cap, you will see that 13 of them are actually APAC banks. And this is primarily important because the high savings rate within APAC helps to increase the economic resilience of this region. And when we talk about the APAC financial sector, what we already see is also actually a diversified mix of developing and developed markets. And within APAC, what we have also noticed is that APAC banks usually pay consistently high dividends. So this part is important because they usually pay around like 50 to 60% of their distributable income as dividends, while reinvesting the next 30 to 40% of distributable income into growth. So by paying high dividends, it actually lays the foundation for a stable dividend income for investors. So this comes to the aspect about quality income for investors. And the next point would be about being a financial sector. It not just consists of banks. It's also consisting of insurance, which is another high growth segment. So as you see here, right, among the world's largest, APAC life insurance industry is actually among the world's largest in 2021, with 5 Asian countries among the top 10 global markets by written premiums. Another key point is that within APAC, the emerging markets, for example, like Indonesia, Thailand, and Malaysia, are expected to grow at an annual growth rate of around 20%. So all these help to present the case of insurance as another high growth segment within the APAC financial sector. So I've covered about APAC financials and also why financials. And the third thing maybe we should all look at also together is that what you will notice is that the name is Lion-OCBC Securities, APAC Financials Dividend Plus ETF. So some of you might be wondering, what is actually in the plus? I would say 3 key things, 3 key catalysts within the plus. The first would be about cushion profitability. So within the past 2 years, we have already seen banks globally posting decade high profits and decade high ROE. And as what Jason mentioned earlier, higher interest rates have already powered an improvement in net interest margins. So this has helped to boost the sector profit. And in 2023, sector ROE for the financial sector globally is actually expected to hit around 13%. So this is around 50% higher than the 14-year average ROE for this sector. So because of this, the key point I want to highlight is that well-capitalized banks are actually more likely to maintain profitability. So I want to repeat again, well-capitalized banks are more likely to maintain profitability. So this is a key point because when I will cover in the later slides that the ETF actually will focus only on the top 30 largest and most tradable APAC financials. So most of them are well capitalized. And during this kind of context, we are seeing the situation unfold, especially when we are expecting US rate cuts happening. Well-capitalized banks will be more likely to maintain profitability. So this is the first point about cushion profitability, which is a catalyst. The second point would be about the tilt towards Asia. So what we have seen and noticed is that banks grouped along the Indian Ocean, especially those stretching from Singapore, are actually home to half of the world's best performing banks. And in the next 10 years, more APAC banks are also expected to join the top global 100 banks. And the third point, in terms of the global wealth, we are seeing it is expected to exceed US 500 trillion this year. So this translates to nearly 5 times of global GDP. And the biggest wealth source, if all of you might have already noticed, will come from APAC. So this translates to roughly 40%. And this rise in APAC wealth will help to catalyze the growth of APAC financials for this ETF. And the third point would be about the APAC financials pivot towards capital light and digital models. So in the McKinsey study, what has been observed is that capital light models actually use much less of the bank's balance sheet, but actually bring higher return on equity and higher net income. So in the last 6 years, right, transaction activities actually use only 16% of capital, but actually brought 33% of profits for the APAC financials. And because of these, a lot of financial institutions are now embracing digital transformation, for example, like AI, data analytics, to become capital light. Specifically, DBS mentioned that in the annual report that digital customers are consistently more valuable with an increasing share of income and higher income per customer. So all these talk about going digital and going capital light is important to help improve the banks and APAC financials' overall profitability. So I've basically covered already 3 key points in what is in the plus. One of it is capital light models. Another is the tilt towards Asia. And the first one was about cushion profitability. So these 3 points. And with these 3 points mentioned and discussed, what you will see that is that APAC financials are actually still at an attractive entry point right now. So in terms of P ratio, which we have seen, we compare to the STI actually consists of roughly 50% of the 50% banks, and these are actually primarily the 3 local banks. So in terms of price to earning ratio, we are actually around half of the STI, and actually more than half of the IHS REIT leaders index. So because of this, we are actually much favorably lower compared to S-REITs or compared to STI. In terms of price to book ratio, we are also considerably lower and favorably lower compared to the STI, and also comparable to the IHS REIT leaders index, which actually documents a lot of the larger cap REITs. But with these 2 metrics in terms of valuation matrix being favorably lower, but if you look at the other side, which is about the net dividend yield, our net dividend yield is actually higher than the STI. That consists of actually the 3 local banks being 50%. And also comparable to the IHS REIT leaders index. So actually there's one special thing about S-REITs is that due to the tax transparency treatment, more than 90% of their distributable income has to be paid out as dividends. But for banks, APAC financials, they usually just paid out 50 to 60% of distributable income. So even just by paying out 50 to 60% of distributable income, the current net dividend yield is already comparable to S-REITs. So because of this, the remaining are considered retained earnings and can actually be regenerated and reinvested, generate growth. So with all these discussed, what we see and notice is that the growth catalysts are long-term and still take time to be priced in. So as we speak, APAC Financials are still at an attractive entry point right now. And another question which some of you might also ask is that we are seeing and anticipating US rate cuts happening. So how will this impact APAC Financials? So the way to look and approach this is that the financial sector is actually an broad ecosystem consisting of businesses that have different interest rate sensitivities and also react differently to rate cuts. So for example, right, we have already this month we are already seeing like savings account interest rates dropping because of anticipated US rate cuts. So because of this, less money actually will be parked into deposits, and more money could actually be invested. So actually, for a financial institution perspective, what you see is actually investors redirecting their capital towards wealth management and also towards insurance businesses. So with this happening, actually it could drive more investment activity within APAC. And this could actually help mitigate and neutralize some of the effects which we see in US rate cuts. And meanwhile, on the banking side, the banks can also protect their net interest margins from lower rates by increasing positions to longer term fixed rate assets, for example, like buying longer duration bonds or dispersing longer term loans. So one key constituent and also key observation we have seen even in DBS is that they really put around 30 billion of fixed rate assets in Q3 and Q4 last year to protect and hedge against lower interest rates. So with all these said, the financial sector is a diversified ecosystem across businesses, and this is precisely why it has prospered throughout the centuries. So because of with all these discussed, what I will discuss next will be about the Lion-OCBC Securities APAC Financials Dividend Plus ETF. And this will be the first APAC Financials ETF in the world. So it tracks the IH APAC Financials Dividend Plus Index, which tracks the 30 largest and most tradable APAC financials companies. And this is designed to provide access to stable dividends and also growth within the financial sector. So in terms of the index universe, what you will see is that the countries include Australia, Hong Kong, Japan, Singapore, which is our home country, Korea, Indonesia, and Malaysia, together with Thailand. So it follows a three-step index construction process. So the first step it will be about eligible sectors, which actually includes banking, insurance, investment services, and also at the same time specialty finance and services. So this is actually a key inclusion because when we talk about specialty finance and inclusion, and services is actually where the digital banks, for example, like Grab and also C's Mari Bank are actually included and parked inside. So this makes the index actually future-proof because if one day they grow big enough in terms of market cap and also become dividend paying and pay consistently high dividend yields, they can actually be included into the index. So this is where the growth element of the index comes in. So where potentially growth, those with potential growth and also potentially high dividend in the future, they could be included into the index. And the index also also uses a 2-year average dividend yield with a threshold of around 3.5% to include new constituents. So we use 2 years in terms of our average dividend yield because some constituents within the index universe could pay high dividends within the first year, but do not pay so much within the second year. So that's why we introduce a 2-year threshold to be able to weed out and eliminate those which just pay extraordinary high dividends within the first year. In terms of index selection and weighting, the free float market cap threshold is around USD 1 billion. And we have also instituted 3 caps within the index. So the first would be about the 7% single stock weightage cap. So because of this, each constituent cannot be more than 7%. And even if they are more than 7% due to market movements, they'll be rebalanced back to around 7% in the next rebalance. And we have also introduced a country weightage cap. So this is actually an important cap, which I will discuss later. And also about 5% country weightage cap for Indonesia. So in the end, what you end up will be an index with 30 constituents, weighted based on free float market cap, with semi-annual rebalancing happening in March and also in September. So there are three key features about this ETF. So they can be summarized into FIG, or as you read here, what you can also think of and visualize would be focus on income and growth. So FIG, focus on income and growth. So when we talk about focus, it's about focusing on the top 30 largest and most tradable APAC financials by free float market cap. In terms of income, will be stable quarterly distribution, minimum 5% per annum for the first 2 years. And we talk about growth, you gain access to potential capital appreciation within the APAC financial sector. And the index was actually launched already back in the 2nd of February. And as you see here, during this period, since its index launch, we have actually outperformed the STI that consists of roughly 50% banks, mainly made up by the 3 local banks, and also the IHS Leaders Index, which has actually had negative return during these 2 months. So during this period, during these 2 months, we rose 8% compared to the other 2 indices. So since the inception, key message, the index has already outperformed comparable indices based on live index performance. So this is not backtested data. This is live index data, where it has outperformed 2 comparable indices within the Singapore market. In terms of index characteristics, what you see here is that you see Japan, Australia, Singapore, Hong Kong being roughly around 20% each. South Korea is at around 16%, and Malaysia is at around 4%. So what you gain and access is actually a financial sector portfolio that's diversified across 6 APAC countries, as you see here, being a colorful mix. And you will see that the top 3 constituents are the 3 local banks within Singapore, DBS, OCBC, and UOB. And within the top 10, you will notice other interesting names, for example, like the Japanese banks, Sumitomo Mitsui, Mizuho, and also the Australian banks, Commonwealth, Bank of Australia, NAB, Westpac, ANZ, and also the Korean financials like KB Financial, Shinhan Financial, and Hana Financial. So all these have been included to help investors diversify beyond the 3 Singapore banks. So I mean, this actually helps to for investors, help them in diversify, not just across the region, but also across different subsectors. And for some investors, we actually understand there is the fear that what if banks suddenly cut dividends when there are interest rate cuts happening, or even an economic slowdown happening. So the key thing is that actually if you just buy DBS, OCBC, or UOB, you would actually face the same problem if there's actually rate cuts happening. So, and the benefit of actually buying through an ETF is that there's actually geographical diversification, as you see here. You are diversifying across 6-7 countries within APAC. So, for example, right, in the event that Singapore banks suddenly cut dividends, the Chinese banks here or the Japanese banks here might actually still be able to maintain or increase their dividends, because they are right now at a different point in terms of their interest rate cycle. So Japan might be expected to increase interest rates during this period. So what happened actually in terms of higher net interest margins for the different banks globally could happen and help Japanese banks. And right now what we see within Chinese banks is that for the past few years, they have been cutting interest rates. So they are already at a different point within the interest rate cycle. So with all this happening and unfolding, this could actually help investors and these ETF maintain the target 5% dividend yield. So no one can predict actually what will happen in the next few years. But this is precisely the benefit what diversification can bring to investors through an ETF. And as an investor yourself, or even myself, it's actually very hard to be able to replicate such an APAC Financials asset allocation on your own. So you see exposure to Singapore banks, but also at the same time Malaysia banks, Japan banks, Australia banks, Korean banks, which is not so easily accessible as a market, and also Hong Kong listed Chinese banks. So realistically, right, actually a lot of us, we might just actually buy DBS, OCBC, UOB. We call it a day. We don't think so much. But doing this actually brings a lot of concentration risk into Singapore. And what this ETF eventually can offer will be a simple and fast-free way for investors like you to gain access to the biggest banks across Asia Pacific. And for passive investors like you, and also myself included, who want to be bothered with different stock picking, and also we want diversification, this new ETF actually will be an interesting option for you to consider to earn both stable dividends and also at the same time invest in APAC Financials. So right now I've talked about the different ETF features so far. I will talk about two key constituents within this index. So some of you can get a flavor of what this index and also this ETF is about. So the first constituent I'll cover will be National Australia Bank. So this is a bank that actually grew 25% in terms of share price since January 2023. So in terms of key results, in terms of key results, they have delivered a strong fiscal 2023 performance with cash earnings up around 9% and also underlying profit increasing by 16% compared to fiscal year 2022. And during this time, NAB actually still retained its position as Australia's top business lender with a 22% of market share. And this is also a case study example in terms of digitalization, because as you see, for its core business and private banking unit that focuses on SME customers, the net profits actually grew around 22%. And all these were actually attributed to its digitalization of account opening that contributed 50% in new account openings since 2020. So this is about National Australia Bank, and with all these happening, this is why its share price actually grew by 25% from January 2023 to March 2024. The next constituent I will cover will be about KB Financial. So for Korean financials, most of these financial statements are actually in Korean. And even a lot of the financial information are in Korean. So it's not so accessible for a lot of investors. And because of all these happening, it's actually an under-invested market because most investors do not have the capacity or competency to be able to analyze the different financials in Korean one by one and pick out the hidden gems. And that's what this ETF can do for you by investing into hidden gems and under-invested markets. So regarding KB Financial, what we have noticed is that in 2023, it actually achieved record high gross operating profit with earnings up around 18%. KB Financial is also an interesting company with two insurance arms. It has own KB Financial insurance arm, and also in 2020, it acquired another insurance unit from Prudential Financial for around USD 2 billion. And this merger was then effective from January 2023. So during this period, after the merger was effective from January 2023, you would see that actually share price grew 50%, 50% during this period from January 2023 to March 2024 within the past 15 months. And with this even happening, actually there's still around 15% upside potential based on the average target analyst price set by the various analysts looking at Korean financials. So it's an interesting constituent with actually a lot of growth embedded, but not so well known to investors beyond Korea, or even to a lot of even to investors that are near Korea. They are not so well known. But through the ETF, what you gain is actually having and including hidden gems with stable income, but also at the same time being able to deliver quality growth for investors. So to summarize, the Lion-OCBC Securities APAC Financials Dividend Plus ETF helps investors with three key things: focusing on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5%. Growth, potential growth within the APAC financial sector. So this ETF will be a key building block for your financial sector exposure in your portfolio. And the SGX tickers are amazingly simple to remember. YLD for the Sing dollar counter, because 5% target payout sounds like a good yield, and we hope you consider earning stable dividends and invest in APAC's financials today. So I'll pass the time now back to Jason, who will cover some of the promotions we have for this ETF.
Hi, Xun Xiang. Thank you very much for your very great sharing. Before we go to the Q&A, maybe I'll just go through quickly on how clients can apply for this ETF, right? Okay. I have shared a link in the chat box. So let's say if you want to find out more about the ETF, you can actually look at the details over here. So currently we are open for subscription until 2nd May. Okay, so to register or to apply for this ETF, right, using your PointsTwo account, you can actually log into your Points web account and do a subscription. Later, I'll just go through very quickly on how you can subscribe using your Points account. Right, so as what Xun Xiang mentioned earlier, these are some of these key information. Subscription period from now till 2nd May, and the subscription price is at $1, minimum quantity 1,000 units. There's zero commission. However, for direct STP account, there will be a $10 transfer fees for your cash management account type. Right. It will be on the full allotment basis. So whatever that you have applied, basically you will be able to get full allocation. Right. So there is a promotion as we just started the subscription. With the first 88 clients that subscribe, they can receive up to $500 cash credit to your points account. So how it works is that for every 10,000 subscription into the Lion-OCBC Securities APAC Financials Dividend plus ETF, you will get $20 cash credit. Right. So you can refer below for more T&Cs. Yeah, so as mentioned earlier, $20 for every 10K subscription. There's a cap of $500 per account. Right. And do be informed that you have to fulfill a 1-month holding period after the listing date, which is on 13th May. Right. And then the cash credit will be credited to your points account 1 month after the listing date. Right. So there are a few more seminars and webinars. So let's say if your clients, sorry, if your friends or relatives, are interested but somehow miss this session, you can still review the recording on our YouTube channel or invite your friends to register for the upcoming seminars or webinars. Right. So I'll go through quickly on how you can subscribe using your points account. So once you have logged into your Poems web, right, go under the stocks online forms, and then under the online forms, you can see the IPO subscription online irrevocable form. So once you click in, you'll be able to find the information right over here, like OCBC APAC Financials. Click on apply and you will land on this page. Yeah, so basically you can actually fill in the amount that you wish to apply. Say for example, you're looking to apply 10,000 units, right? And then it will calculate what is the total amount that you need to pay, right? So let's say okay with all this thing, look through all the information declaration, basically some of these T&Cs. So and then key in your password over here. Yeah. So it will say that your application request is successful. Do take note of the total amount payable and have it ready in your account by 2nd May 5 p.m. as we'll be doing the deduction by then. So any application will be rejected if there's any sufficient funds on that date. Right. Okay. So maybe you can go back to the presentation slides to answer any Q&A.
All right. Okay, I think I see one question about why is there a 5% dividend guarantee for 2 years? Okay, so the thing is based on we have back tested the index for more than 10 years, even beyond 2012, to be able to arrive at a dividend yield. And what we see is that dividend yield has mostly been above 5%. So that's why we believe it's a achievable number we are able to pay. And second thing is also in terms of the dividends, we are paying them based on what the underlying constituents are paying. So as you see, right, by Jason, can I share screen? Okay. So if you look at the dividend yield of the index right now, what you notice is that the current net dividend yield is already at 5.9%. So we are actually able to meet the 5% dividend yield requirement. And that's why we set it as something achievable that we are able to pay based on the dividends we receive from the underlying constituents. And in the event really, if for example, a few years later, we are not able to have sufficient dividends, we will still pay out from capital. But that is what we absolutely want to minimize in terms of likelihood, because based on all the back-tested data and performance, we are relatively confident that we can pay just based on the dividends received to meet the 5% dividend yield requirement, which we set for ourselves. Thank you.
There's an earlier question on can we use CPF or SRS to purchase, right? So she has replied. Just also share, right, for this ETF subscription, it's only for cash during the subscription period. So once the ETF is listed on Singapore Exchange on the 13th of May, right, then investors can actually use the SRS and or cash to invest, right? And there's another question on any replay for this Zoom. Yes, so this webinar session will be available on our YouTube channel, PhillipCapital YouTube channel.
I think there's a question about percentage invested in insurance versus banks. Okay, keeping our share screen again. So it's roughly around 85% banks now and around 10% for insurance. So I think the key is actually having the greater bank portion helps to support the 5% dividend yield. And maybe another question which I think some of you didn't ask, but I think I can address upfront, is that actually some of the banks, right, in terms of the market cap, they are probably larger than the Singapore banks. But actually, why are they actually weighted lower than the Singapore banks? So I can address this upfront. So because you remember earlier in the part, I talked about the country weightage cap of 20%. So this is actually one of the key, because in Singapore, there are only actually 3 local banks. So it's actually the 20% cap split into 3 different banks. But in China, there are actually a lot of bigger banks. So you really see the big 4 Chinese banks and also some of the other among the top 6, for example, like China Merchants Bank. So this 20% cap is actually split across more constituents within this period. So with this happening, actually, it means we are able to equally and efficiently represent each of the country within the index universe for this ETF.
Okay, there's a question on what is the time frame, right? Long term. I believe the question may be asking something like, how long do you think an investor should hold this ETF for? I think it is a bit technical question, but maybe you can try to address this.
Okay, I think okay, for this ETF, it is more okay. What we believe is that it's suited for income focused investors that want to receive reliable and sustainable passive income, because this ETF aims to pay 5% in terms of dividend yield. So and we pay it quarterly. So because of this, it actually helps to replace. I mean, instead of just holding the three Singapore banks, and if you wish to diversify beyond the three local banks, it's actually recommended as a long-term holding because you are able to receive 5% per annum in terms of income, quarterly passive income, while at the same time diversify beyond the three local banks and also diversify beyond the region, beyond the Southeast Asian region. So I think this is one thing. And second, while investing and also receiving stable passive income, you also at the same time gain access to growth in the APAC financial sector. So the financial sector is basically in the business of providing capital, and it has powered and provided economies with capital worldwide to enable trading. So it's actually a sector that, since it has been an old sector that has prospered throughout the centuries, it is a sector that, because you are in the business of giving money, so and also managing money. So it's a sector that usually, and based on historical track record, is set to grow and it is stable. So because of this, we believe, I mean, for investors, it probably will fit into more on the long-term allocation for investors to be able to fit your portfolio and also your time horizon. Slide 17.
Yeah, and just to add on, right, I think for a quarterly paying dividends stock or ETF is, I would say, quite uncommon on Singapore exchange. So I think like what Chase has mentioned, it definitely help a lot in terms of like providing that ease of investing to 30 companies, 30 good quality banks in the APAC region, and then consolidating all the dividends for the investors and pay out on a quarterly basis.
Okay, I think there's one question about whether it's currency hedge. Okay, right now okay, we are not hedging in terms of currency for this ETF. And since Sing dollar is strong now, actually this could actually be favorable for investors. And I think there's also one question about what do you see as the threat of digital banks and CBDC? So I think for the question about digital banks, you can remember I mentioned earlier in terms of the index criteria, right? Okay, this one. It includes specialty finance and services. So these component actually includes the ones that are actually digital banks. So if you look at the FactSet, RBICS, C and Grab are actually part of specialty finance services. So if one day they grow big enough in terms of market cap and also pay sufficient in terms of dividend yields, they could get included into the index. And this is what makes the index future-proof for longer-term investors. So we believe actually if digital banks eventually grow, this could actually be better because they eventually could be included into the index. Okay.
Okay, maybe I'll save the last question for myself, right? So, Xing Xiang, maybe on a personal note, right?
Yeah.
How would you use this ETF for your personal portfolio?
In terms of how would I thank you, Jason. I mean, for asking the question, I think it's something interesting because other than talking about the key facts about the ETF, so personally, how would I use this ETF for my portfolio? So I think, okay, for one end, I think when we usually build a portfolio, the key is actually having a core satellite approach. So the core will be actually having a base and foundation to be able to actually generate stable passive income on the portfolio. So we are able to meet, for example, critical and crucial expenses. And for this ETF, what I would say is actually this nicely fits into the core portfolio allocation because there's this stable passive income, at least in the first 2 years from what we see, 5%. So for example, if we invest 10,000, we already know that we will get 500 back. So if it's 100,000, it's actually 5,000 back. So in terms of this stable annual income and being paid quarterly, we do know that some of the expenses we have are going to be taken care of. So I think when we talk about building a portfolio, having this cost satellite approach, I think having this as a long-term allocation will be important to be able to meet different needs and also at the same time achieve a certainty in terms of income stream.
Thank you very much. Yeah, okay. There's one question from Peter. I do not have a points account. How do I get started, right? Yeah, so you can actually do an online account opening with poems, and then you can actually do the subscription once the account is open. Yeah, so from now till the end of the IPO subscription, it's about 2 weeks from now. So I think there's sufficient time to open the account for the application. Right. So thank you, Xiang. I think we have come to the end of today's webinar. Maybe in closing remarks, do you have anything to share in the last note with our, investors over here?
Okay, so in terms of closing remarks, what I want to emphasize and also highlight is that this ETF is about two key things: earning stable dividends, 5% per annum quarterly distribution, and also the fact that it is the world's first APAC Financials ETF. It enables you to actually not only gain stable dividends, also at the same time assess potential growth within the APAC financial sector. The SGX ticker is amazingly simple to remember. YLD, you can think of it like yield because it is meant to and designed to help you achieve a good yield for your investments. So thank you everyone for participating and joining today's webinar. Pass the time back to Jason.
Okay, thank you, Xiang, once again. Yeah, so we have come to the end of the webinar. So if anyone have any question regarding the subscription or have further question with regards to this ETF, right, do feel free to email to etf@phillip.com.sg. So once again, thank you, Xiang, and everyone that's joined us today, and we hope everyone have a good day ahead. Thank you.
Thank you, everyone. Cheers.